Hello and welcome back to the Note. This week we have seen what you might call confirmation of a theory that many people have been working on for some weeks, and you've also seen capitulation by many of those that were holding out. Now, that theory is that the US really will be tightening rates later this year, probably as early as June, while more or less everybody else in the world decides to cut their own rates. That will mean flows of funds moving towards the US. It will mean a stronger dollar, and the stronger dollar has impacts everywhere else. There were two critical events that have led to that capitulation that we've seen this week. First of all, the ECB confirmed the details of how it's going to go about QE bond purchases starting on Monday. Secondly, we had unemployment data from the US on Friday, probably the single most important data underlying what the Fed is going to do. This shows you clearly enough why people are now convinced that rates are going to be rising. We're showing you the unemployment rate, which is now down to 5.5%, and we're comparing that with the Fed funds target rate over the last 20 years. You can see that the last 3 times unemployment was at exactly this rate. The interest rate, the Fed funds target rate, was 2%, still very low in historical terms, but not a crisis extreme level such as we have been at for the last 6 years. Very hard indeed to see how you can justify keeping rates as low as 0.25% on that basis. Obviously, if you go back further into history, then rates tend to have been higher still when unemployment was at about this level. Now, let's take a look at the impact of the ECB. What we're looking at here is Treasury bond yields compared to German Bund yields, and you can see that German Bund yields remain remarkably low, even as Treasury yields have risen quite noticeably in the last month. That increases the pressure for the dollar to rise. It increases the interest in moving assets towards the US. Plainly, there is a belief here that the ECB will succeed in keeping yields down in Europe, which is what a QE program would be aiming to achieve. Now, why was the ECB interested in doing this in the first place? Because there was a deflation scare. We can look at that clearly enough by looking at the implicit inflation expectations in the gap between inflation-linked and fixed income bonds. And again, you can see that the mere announcement that the QE was coming seems to have been enough to allay that deflation scare. You've seen a very sharp rise in 5-year inflation expectations for Germany, and you've also seen a rise for the US. Those levels remain low, but the extreme deflation scare that had many people thinking that the Fed might not raise rates after all is over for now. Now, what is all of this going to mean for the dollar? Well, we're showing you here is the dollar trade-weighted exchange rate going back a while, and we're also comparing it to the oil price. For reasons I'm not going to bother to go into just for now, there is a strong correlation over time between the dollar and oil. The cheaper oil is, then all other things equal, the stronger the dollar will be. You can see that a large part of the recent rally in the dollar to highs that it hasn't seen in more than a decade now was because of the big sell-off in oil. The last month or so is different. You've seen oil rise and stabilize, but the dollar has gone on a fresh new tear. Why is that happening? Largely because now there is the belief that the Fed really will raise. Today you saw an extremely sharp rise in the dollar. You saw a very sharp rise in bond yields. That is because there is now an acceptance that the Fed really is going to go through with raising rates in June. What do we need to wait out for now? We need to see what the impact of QE is in Europe when it finally starts next week, and then after that we will have a very important Fed meeting where, unless people are very much wrong, we are going to see the word patient dropped from the Fed's communique. That would be signalling that they could raise rates as early as June. But for now, what we have seen this week is a very significant capitulation. People now really do believe in a story whereby the rest of the world will be cutting rates while the US raises them.